Welcome to Balance of Economy. Before we dive into the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or a recommendation to buy or sell any asset. Let's look at the numbers. 60 years. That's a long time for any relationship, right? Well, that's exactly how long the United Arab Emirates has been a cornerstone of the OPEC cartel. But as of May 1st, 2026, that era is officially over. We're talking about a historic rupture here. The UAE is walking away from both OPEC and the wider OPEC Plus alliance, right at a moment when global energy markets are in absolute unprecedented turmoil. I mean, Brent crude futures are holding firmly above $110 a barrel as we speak. This isn't just a tiny policy tweak, it's a massive, seismic shift in geopolitics. The third largest producer is literally packing up and leaving, removing a crucial pillar of OPEC's power and completely rewriting the rules of the global energy game. So here's our roadmap for this explainer. We're going to cover 1. The Great Gulf Divorce. 2. The Strait of Hormuz context. 3. Quotas versus true capacity. 4. Funding the AI economy. 5. The oil price volatility impact. And finally, 6. Investor risks and fallout. Let's get right into it. Part 1. The Great Gulf Divorce. You know, for years now, there's been this quiet, growing tension between Abu Dhabi and Riyadh. And when you compare their opposing strategies, honestly, the breakup makes perfect sense. On one hand, you have the UAE. They just want the freedom to pump more oil, maximize their infrastructure, and aggressively grab global market share. But on the other hand, Saudi Arabia really prefers to play the role of the ultimate swing producer, enforcing strict quotas to artificially prop up those global price floors. Add in some differing geopolitical approaches in places like Yemen and Sudan, and the UAE basically said, we're done being constrained. Part 2. The Strait of Hormuz context. Now, to really grasp the timing of this exit, we've got to look at the physical reality of the global oil market right now. And frankly, it's in a state of absolute crisis, which brings up a really fascinating paradox. You might be wondering, why leave the cartel right now? Why pull the trigger on a massive, disruptive pivot while the Iran war is raging and tankers are completely blocked in the Gulf? Well, it actually brilliantly illustrates the UAE's strategic timing. Because of the blockade in the Strait of Hormuz, roughly 20% of the entire world's oil supply is just trapped. The tankers physically can't move. So by announcing their exit right now, the UAE is ensuring there's absolutely zero immediate physical supply shock to the global markets. The blockade is essentially muting the impact of their new supply flooding in. It's the absolute perfect moment for them to legally break free from their OPEC quotas without crashing prices today. Part 3. Quotas versus true capacity. Let's dig a little deeper into the raw numbers that have really been fueling the UAE's frustration. There is a massive, glaring gap between what the UAE is allowed to produce and what they can actually produce. Under the old OPEC Plus agreement, their quota historically kept them capped right around the 3 to 3.5 million barrels per day mark. But their true capacity? It already exceeds 4 million barrels right now, and they're aggressively targeting 5 million barrels per day by 2027. For them, staying in OPEC meant literally leaving billions of dollars stranded in the ground every single day.
Part 4. Funding the AI economy.
Because here's the thing, the UAE isn't just pumping more oil for the fun of it. This whole dispute ties perfectly into a massive macro theme we've been tracking, which is accelerated monetization. The UAE leadership sees the writing on the wall. Just listen to what their energy minister, Suhail Al-Mazrouei, said. He noted, the oil, no matter how attached we are to defending it, is entering a phase of decline. To secure their future, they are aggressively transitioning away from a pure oil economy and diving headfirst into the AI economy. So how does this accelerated monetization playbook actually work? It's basically 3 steps. Step 1, unleash maximum oil production, finally completely unconstrained by OPEC. Step 2, use that massive excess capacity to aggressively steal global market share and generate a huge spike in immediate cash flow. And step 3, redirect all that immense capital to fund the future. We're talking about financing a staggering $650 billion global AI compute and data center infrastructure build-out, plus honoring a $100 billion clean energy pact with the US. They are literally liquefying their oil assets today to build the digital and clean energy infrastructure of tomorrow. It's an incredible pivot.
Part 5. Oil price volatility impact.
So, what does this massive structural shift actually mean for oil price volatility? Well, the return of a true free market dynamic without a unified cartel pulling the strings sets up a really wild timeline. In the short term, prices are going to stay artificially high. We're talking well above $110, simply because the world is running on fumes with the Gulf blockade. But look at the medium term. Once those tankers start moving again, the UAE is going to inject a massive wave of new supply. And in the long term, because global oil demand is highly inelastic, a mere 2 to 3% increase in global supply from an unchained UAE could easily trigger a steep 7 to 10% plunge in global prices. Part 6. Investor Risks and Fallout. Finally, let's break down what this paradigm shift actually means for you if you're holding portfolios tied to the energy sector, because honestly, the financial risks have just multiplied. First, look at CapEx risks. If a price war kicks off, high-cost producers outside the Gulf are suddenly going to find themselves holding completely unprofitable, stranded assets. Then you've got margin compression. Without OPEC acting as an artificial safety net, investors are staring down severe margin compression as competitors are forced to slash prices to survive. And lastly, geopolitical instability. The breakup of these huge historical Middle East alliances makes the entire region way less predictable. And that means we're looking at sudden, violent swings in both supply and pricing for years to come. That's the data for today. Now, I want to hear from you. Is the UAE's exit the beginning of the end for OPEC, or just a new chapter in energy competition? Drop your thoughts in the comments below. Don't forget to subscribe to Balance of Economy for high-density market insights. Stay sharp and stay informed.